With continued market uncertainty coupled with increasing individual investor engagement, it really led to one of the biggest trends in the industry right now, which is using the ETF wrapper to easily offer strategies once reserved solely for institutions and hedge fund investors. Joining me now is Paisley Nardini, Managing Director and Portfolio Manager at Simplify, along with financial futurist Dave Nadig. Now, let's first set the stage for this conversation. Today, stocks are retreating and yields are spiking on Moody's lowering its credit rating on the United States. But at the same time, we're seeing reports of individual investor optimism returning to levels that we have not seen since the beginning of this year. Now, let's talk more about some of the specifics around some of the products and strategies that you're currently running Paisley, including managed futures strategies, hedged equity strategies, high yield strategies, and those types of things. So Paisley, what exactly is driving the demand for some of these alternatives-based ETF strategies?
First off, thank you for having me. Excited to be here with Dave for today's conversation. Really, the investor adoption and interest in these strategies is just driven by this continued uncertainty. I think what we saw in the first half of this year, which has really continued despite the rally we've seen in equities, is uncertainty of future outcomes. And I think where we are even seeing rates back up to today is another reminder as to whether bonds will play that role as ballast in the portfolio. And so some of those strategies you mentioned are really at the forefront of the conversations that we're having with clients, whether it's large institutional allocators or high net worth, thinking about differentiated sources of risk and return, thinking about ways to lower correlation in the portfolio, and really thinking about ways to kind of diversify away from broad-based equity beta. I don't see a lot of meaningfully positive catalysts in the near term as to why markets should continue to rip higher, just despite some of that positive momentum we've seen. So low correlation strategies, strategies that are dynamic, strategies that are flexible, can be long or short, and can really adjust with the market news and the backdrop that we're seeing. And every bit of information that's coming to the markets is moving asset prices. And so being able to be more flexible, we think, is really the best way to move forth as you're thinking about building a holistic portfolio.
Now, Dave, it brings up another interesting point here. These types of strategies that are in ETF wrappers, they're not especially new. We've seen the evolution of some of these kind of active models, actively traded type ETFs, stock selection ETFs, even long-short equity ETFs, options kind of overwrite ETFs. But what exactly is it now that is maybe driving a little bit more of that interest in these types of products? Is it simply the volatility that we've seen from a headline perspective, given everything else in the macroeconomy?
Yes, certainly volatility is a big part of it. But honestly, the short answer is look at today. Just look at what's going on in the market today. People are selling bonds and they're selling equities. A lot of advisors, a lot of individual investors have kind of been trained that that's not how this is supposed to work, right? Bonds are supposed to be the thing that zigs when the equity market zags. And what we've started to realize is because of this sort of anything but the USA trade that seems to be going on, whether it's investors in the US or investors outside the US, we end up with these situations where we see bonds and equities going the same direction at the same time. That's fine if what you're doing is just trying to maximize your upside risk and you're looking to buy a bunch of risk assets. But that's a problem if you're trying to get real diversification. And strategies like, say, CTA, which is a managed futures product, they're really designed to be counter-correlated in a way that you can't expect bonds to be in the face of this kind of chaos that we've seen. So I think we really do have to give investors some credit. We've gotten $1 billion in flows into alt strategies so far this year, $2 billion over the last trailing year. Investors are smart. They know they need something better than just another long bond.
Okay, Paisley, that begs the question. If there are all of these types of strategies out there, there also has to be some kind of an education element with regard to what these investors are actually buying. You mentioned that the evolution of this has been coming from the institutional side of things and now has worked its way towards retail. I wonder, from your perspective as the manager of many of these different types of products, Where exactly is the investor demand, whether it's retail or institutional? What types of strategies are you seeing the most heat, if you will, developing in this market?
Yeah, I think you mentioned a really good, important point, which is education. As we think about moving beyond traditional, fundamentally driven stocks and bond selection and portfolios, we're now talking about the use of derivatives. The ability to take leverage through futures positions is one example, the ability to take long and short positions. So, as we think about educating our investors to ensure that they're using these appropriately, that is a very salient point and something that Simplify is very keen to do through our website and through client engagement. So that's first and foremost. I would say where we've seen a lot of interest is, and I think this kind of goes back to something we're hearing from clients directly, is not wanting to take active risk, or at least not wanting to be the one behind the decision as to when and how and where they're taking active risk. Essentially, outsourcing that decision to managers that can take those active decisions for them. And so, as it relates to where we're seeing interest in our strategies, it is these more dynamic strategies. Managed futures is one of those where we're able to scale in and out of bond positions. We're able to scale in and out of commodities when our models are telling us it's advantageous to do so. And so there's a bit of relief then from the allocator's perspective that they're off the hook from making that decision, essentially outsourcing from an investment decision perspective. So long, short commodity and interest rate futures, another strategy that's been garnering attention just given the backdrop of tariffs, trade negotiations, and kind of dislocations of central bank policy globally is in a long, short commodity, FX strategy. So thinking about currencies, the ability to take long and short, but do so in a way that is a neutral position to the US dollar. I think that's another kind of uh, defining decision right now that investors are making is whether or not they want to be long or short the dollar. And so the way that we approach FX investing is you don't have to make that decision. You're really just looking at carry and momentum within currencies broadly. So those are two areas I think we've seen a lot of interest just given the backdrop that I shared.
Paisley, could I follow up really quickly? You mentioned the managed futures side of things, or the CTA ticker that we saw. I mean, yes, CTA is there for a reason, right? Because it's a commodity trading advisor. That's the acronym that a lot of people in Wall Street kind of are familiar with. Those are trend following strategies that kind of use computerized models to track momentum one way or the other. How much do the retail investors that traffic in these ETFs have to understand about these strategies? And then how much, you mentioned the outsourcing from investment advisors, how much do investment advisors play in terms of a role in themselves educating the people that they are allocating to these particular strategies?
Yeah, I think the biggest educational hurdle in CTAs or managed futures is that if you haven't had familiarity or experience investing via futures contracts, there is embedded leverage, right? You're only posting so much in margin in order to gain that exposure. And so that can be in the upside and the downside over time. I do think when we distill what managed futures are seeking to do, it becomes a little bit more digestible or approachable for a lot of these high net worth advisors, and that many of them are already allocating to long only commodity strategies. Many of them are already investing in bonds. And so the access that we're giving them to interest rate futures and to commodity futures outside of that leverage component is just the additional ability to take long and short. And I think because of all of the shifts and gyrations that we're seeing in the market, being able to be short a lot of these markets has been advantageous over the last 6 to 12 months, just given the dislocation. So very much educational component, but really when we look underneath the hood, I think these become a little bit more approachable for the high net worth advisor.
Dave, there are opportunities here, right? And the reason why these products are coming to light is because there is demand that's building out there for it. I wonder if you could take us through a little bit about maybe what type of demand profile there is and whether or not there will be other entrants to this market to offer these types of ETFs because the demand side will grow from investors.
Yeah, the challenge here is that there's good ways of doing these kinds of things and there's bad ways of doing these kinds of things. And I think that's part of the education point. The demand is definitely there. We've seen active, just as a class, active versus passive, is now running about 50-50 with passive in terms of all flows. That's across equities, alternatives, bonds. Active is really having its day in the sun. Almost every dollar is coming in split between active and passive. In some cases, that's a great thing. It does allow investors this flexibility. But what we've also seen is a lot of complexity, a lot of leverage, and a lot of fees show up in the ETF industry over the last 6 to 12 months. products like CTA, which are clearly designed to kind of be an alternative beta in a portfolio context, those are great. And you can dig into the math and understand what they're doing. But when you're an advisor or an investor and you're looking at the whole realm of things that are on that menu, a lot of these products are going to be very expensive. A lot of them may be taking more leverage than you really want. So when you start bridging away from sort of the big names we all know and the core beta asset classes, investors really do have to pay attention. Make sure you know what you're owning, why you own it, and how much you're paying for it.